Review of DMart, a stock for a smart investor. DMart started their operation in 2002 as a one-stop supermarket, discount supermarket. Today has 216 stores across 76 locations in 11 states, planning to double their store presence by 2025. Good margins, good business growth. Let's look at the rankings. Price rank is at 81.5, very good ranking, and this stock has always been at the top ranking, always garnering the attention of investors. It's a consumer play giving rich rewards to its investors. So investors always keep taking bag loads of profits from the stock. Earnings rank is at 40%. This stock has taken a small hit during COVID. Looks like it is turning around from the hit that it's taken in 2020, early 2020. Coming to the ranking chart, DMart was at 87.9 in July, went down close to 55 during October, and afterwards it's had a good climb up, not very steep, good climb up, ending at 81.5. So stocks above 70 are worth tracking, above 80 are worth to be in a portfolio. So DMart qualifies its presence in every portfolio, provided we buy at the right levels. Coming to EBITDA, positive EBITDA, there was a very big growth between June to December. From June to September, there was a uptick, and between September December, again it continues on a steep manner. So this 23% EBITDA growth means a lot for the stock, and it's already front-ended that growth, and the stock is already rallied. Coming to TTM EBITDA, which was at 22% 2 years back, due to COVID it took a hit and now recovering. So good stock to look at, of course not at a beaten down price, it is already priced higher. Compared to peer group comparison, on both the rankings, there are not many companies listed in this category. DMart ranks the best in price rank, that is, the stock has been doing excellent in the market among the peers, while earnings is the lowest. That is because if future retail numbers can't be believed. So obviously that number might not be worth taking for a comparison. Coming to business growth, profits always had been in profit. Now due to COVID it's declined, while that is DMart has hit COVID right at the center. It says, I am not worried. It started forgetting COVID and recovery has started. Margins have been showing slight improvement in the recent quarters, though sales are yet to pick up. Profits are even down. With the change that is coming in the economy, business is likely to show up, because always DMart has huge crowds in their stores. So long as India is continuing to grow, these kind of businesses will have tremendous growth opportunities. Coming to investors, FIIs as always were the smart ones. They been picking up the stock for a good long time and been making consistent returns from it. Retail have been selling, probably they are profit booking from the stock, thinking that it is overpriced. Maybe, may not, we don't know, because the stock defies logic. It keeps going higher and higher. PE will be very highly expanded PE the stock has. Mutual funds have also been adding to their portfolio. Coming to the charts, very new sibling into the market, very much protected from COVID. When the COVID drop happened, stock did not go down. The business kind of took a hit. Stock went just to the value levels. That's where it became very attractive to buy. It went into a consolidation for nearly 6-7 months and afterwards takes off. This consolidation is what took down the ranking. So when we are tracking rank along with the price move, if price is not dropped and ranking is going down, begin to have that stock in your track list. Whenever there is a breakout, those stocks will have excellent returns. That's what happened with DMart. Breakout comes somewhere in November. Today, from the breakout level, the stock is about 30% up. That's the beauty when breakouts happen. So price rank will help us identify strong stocks even in a range market and help us enter after a breakout. Now this stock is kind of showing tiredness. It can have one more swing on the upside. Can have it in the track list for both swing and investment opportunities. A stock that has been growing at 10 plus percent. So any business which is having a long visibility and has more than bank rate as its growth obviously will give very good returns. Of course, we should buy it at a right valuation. Presently, DMart valuation is kind of very much stretched. Let's look at the numbers. 1.92 lakh crore market cap. When it got listed, it was at 40,000 crores. 5 times market cap growth in about 3 years. Beautiful growth for the investors who entered into the stock at the time of listing. PE is at 200, where sector PE is 140. Even the sector PE getting bloated is because of this stock only, because very few participants in that sector and this stock leads them. So obviously the whole sector looks very much expanded. That is risky. While with kind of consistent growth and very high visibility, looks like the stock can deliver even more. 24 analysts are tracking. Out of that, only 7 are giving a buy signal. So again, there also it shows that stock is kind of overpriced now, needs a correction, which may not happen because the stock always defies logic. It will not correct. It will go into consolidation and then a breakout. Target from the analysts who are tracking is 3,500, just about 20% from where the stock is now, while after a correction, there is a possibility of even having 50%, 60% returns. Performance against NSE 500, the stock always beats the NSE 500 3 times, 4 times. On a yearly basis, 3 times, 3 months, twice. On even the monthly returns, it is about 40% more than NSE 500 returns. If you want to buy, wait for a correction, get in only at buy levels, get to know the risks, get comfortable with it, and then make a decision to buy. All the views shared are thoughts and ideas on the stock market from our side. There are no recommendations given to buy or sell any stock. Thank you.